Hi, Tracy.
Tony, how are
Yes,
you? So good to
I'm good. How are
see
you?
you.
Thank you. It's
Good,
good to be
good.
seen.
It's been a while.
Yes.
Yes. So what? All right. So the Fed held rates. That no big shocker there. I don't know if you had a chance to read the statement, but
Mhm.
it- what are your what are your first thoughts about this decision? Do you think it was more data driven, or are they just kind of trying to maintain some flexibility?
Yeah, I think things are okay. Inflation is in a comfortable area, making progress. Yeah, there really wasn't an expectation to move because first of all, it's not pressing. Second of all, there are so many other moving parts right now that I think it would have been probably imprudent of them to make a decision right now, given tariffs on the horizon, given some of these other geopolitical issues around Russia, Ukraine, and the potential impact on global oil price that could come from that, other things. I think it's just a good moment for them to wait and see. I was very happy to see that they'll continue to pull back on the Fed's balance sheet. They're slowing it down, but the balance sheet now is back to where it was in May of 2020. So there was a huge expansion of the balance sheet between March and May, but they're back to May of 2020, which is good. It was at $9 trillion, and now it's less than that. But it's good to see that they're going to continue to push, chip away at that. And so we start to get normalization of Fed behaviors. We start to see not fiscal spending necessarily pushing Fed behavior. We start to see domestic economy, international risk, other things being those indicators that the Fed is following. And that's normalization, which is a good thing for all of us.
And what do you think this means kind of for U.S. Treasuries right now? We've kind of seen the 2 and 10 start to narrow. People are worried that's kind of recessionary. What are your thoughts about that? Do we continue to see that, or um, is it a
Yeah,
concern of the Fed?
I think it should be a concern of the Fed. I mean, we're in that place where bonds have to rally so that stocks have to become less attractive so bonds can rally. I know that's not a real popular thing to say, but we need the 30-year to fall faster so that there's a broad-based wealth effect in the economy. Equities, trading hits a relatively narrow swath of the economy. House prices hit a broader swath of the economy. So um, Scott Bessent is trying to really reduce that 30-year yield so that people who hold mortgages can trade up in houses or something like that. I mean, so many people are trapped in a 3% mortgage. He's trying to give homeowners some flexibility. So, we've seen the 30-year rise slightly on this. We've seen the dollar. Where's the dollar? The DX right now is up slightly, but it's at 103. So, it's come down dramatically. Oil is up slightly. I think people are really waiting until the presser because um, we normally hear there's some mess up in the presser that Powell makes that the other Fed governors have to come back in over the next week and correct. So you'll know
Right.
what he's really feeling by some mistake that he makes, and then what the other governors come back in to say in the wake of it.
Uh, Absolutely. Do you think, how are you feeling about what the Fed is going to signal as far as rate cuts for the rest of the year? I mean, you think this is going to be kind of hawkish or dovish? The market seems to think, or is pricing in two, but the market has generally been wrong for the last couple of years. So,
Yeah.
what are your thoughts?
Yeah, I think he's going to be hawkish with a dovish option. I know that sounds a little bit, crazy, but he doesn't want to show dovish cards yet, but central bankers want to cut rates. That's their de facto position. And so The consensus right now is saying June is the first cut. I wouldn't be surprised to see one in May because of the progress that's being made on inflation. So if you look at, everyone's go-to for the past few months has been egg prices, right? They were $10 plus, a few months ago, and now they're, I don't know, $6 or something. So, just in how inflation feels, I think that's changing a bit over the past few months. And I think as inflation feels like it's less impactful, and as we see equities, say maybe plateau, as yields need to fall, I think it could be a signal for the Fed to start cutting maybe a month earlier than consensus. So we could potentially see a cut in May instead of June. So I think we'll see 3 to 4 this year. I think consensus is 2 to 3. I think we'll see 3 to 4.
Wow, 3 to 4. How do, we're hearing this narrative, inflation is coming down, which it is slowly. Yet they're talking about how inflationary tariffs are going to be. So how do, particularly traders trading this market kind of reconcile that?
Yep. Yeah, this is anybody who's heard me talk about this will be tired of this and they can mute me for the next 2 minutes. But so there was a study done by the US Commerce Department in May of 2023, released in May of 23, talking about the impact of tariffs under the first Trump administration in 2017, 18, 19. And what they showed pretty consistently was that the impact of tariffs was temporary, meaning the tariffs had an impact of between, say, 6 weeks and 4 months. In that, after that initial time passed, the prices came back to, say, a world price of goods. So there is an adjustment period, and I believe that the administration is right in as much as when tariffs are levied, at least at this point in history, the exporting country finds a subsidy for those tariffs. And the biggest exporting countries that we're looking at in terms of our tariffs are China, Canada, and the EU. And so anything that we levy a tariff on between, say, 6 weeks and 4 months, those economies will find a way to subsidize those exports. So the prices of those goods for American consumers will revert to a mean. So it's not all necessarily going to hit at once because all supply chains don't happen at the same time. But there will be a temporary impact. The administration has been transparent about the fact that there will be a temporary impact. But once you hit that 6 week to 3 month period, depending on the product, those prices will normalize to, say, a global price of those goods. And U.S. Customs and the Commerce Department benchmark global price using import price data, meaning what's the price they have at U.S. Customs and what's the price in, say, the UN Comtrade database, which is effectively a global price.
Excellent. That is very good information for us. So I wanted to talk a little bit about, let's talk about a little bit about the labor market, because that has a dual mandate, as Powell
Sure.
loves to say over and over and over again,
Yes.
which is inflation, right? Price
Only two
stability.
mandates?
And well, that they're allowed to say that they
Right.
that they govern, right?
Yeah.
I'm sure they have a lot more, but they can't state that exactly. But let's talk about the labor market. So there is also kind of this, analysts are kind of talking about, again, this, 2 and 10 year signaling a recession, and they're comparing it to like 2008, 2020, saying that, we're going to get huge unemployment, huge unemployment because it's going to move 100 basis points, and this is going to cause a massive, recession and problem. Do you think
Sure.
that's kind of a little bit overreacting? Because it seems like the labor markets, well, if you believe the BLS, first
Yeah.
of all, but
Yeah.
the labor market to the Fed seems okay. So what are your thoughts on the labor market?
Yeah, I think, when we hear about the labor market this year, we have to keep in mind where that commentarian is. Are they in DC? Well, given the given the layoffs that we're seeing with the federal government, we're going to see a lot of layoffs in DC. So anybody who's sitting in DC who's talking about unemployment, they're going to see with their eyes that a lot of their friends have been laid off from the federal government. So there's going to be a negative bias there, meaning they're going to amp up their unemployment expectations because they're seeing houses for sale, they're seeing their friends unemployed, they're seeing people looking for jobs, and so on and so forth in DC, Northern Virginia, Maryland, and so on, right? So BLS economists are in that area, and they're probably making a point in their narrative that unemployment is going to be bad so that the US government doesn't lay more people off. Because government spending is not a small part of the GDP calculation, right? So when we look at other places like Texas or other, relatively large population locations in the US, unemployment in these places is okay. And so when you look at the Fed year-end unemployment forecast, it was at 4.3%. Now it's at 4.4%. So they're expecting a slight rise in the unemployment rate, but not dramatic. The year-end core PCE, they're saying it'll be 2.5, it'll be 2.8%. I'm sorry, instead of 2.5%. So I think there's a little bit of 1980s era tariff economics in that. And they haven't really factored in substitution and subsidy effects into that. So I think their PCE forecast is a little bit high. And the Fed cuts here on GDP. Okay, so GDP, they're saying GDP will fall from 2.1 to 1.7% growth this year. I think that's a little aggressive. I think we'll see growth somewhere in between there. I mean, GDP, look, it's a made up number, but I think it's probably somewhere in between 2.1 and 1.7.
So, what should, because a lot of our audience is obviously traders. So, if you're looking at this data, how does a trader sort of digest this information that, came out today? I mean, it's kind of in line with the expectations. The market's not really moving. It doesn't seem to be that excited, but, kind of from a trading standpoint, how would you look at this market right now?
Yeah, I would segment it into probably three different horizons. Between now and April 2nd, when the new tariff stuff comes in, you'll see some last minute deals done between Trump and individual trade partners. And some of those could surprise to the upside. So if there's a deal done between, say, the US and Canada or US and Germany or something like that between now and April 2nd, that could be really good for markets, could be really good for commodity prices in some cases, right? So I would pay attention to news flow, particularly between now and April 2nd. And then in the wake of April 2nd, I think there's a contingent of people around there who think that Trump is bluffing. And so they won't do anything until after April 2nd. And then you'll see a downside bias for certain trade partners and certain industries, but there could be some very good agreements that come out post April 2nd on an individual country basis. I would guess China wouldn't agree anything until after April 2nd. And then you have, say, the medium term after April 2nd. So you're talking from, say, June onward. And so, I've said since November that China is going to try to play hardball with the US for 3 to 6 months. And that's for domestic reasons. I mean, China is a very nationalist country. The US is accused of being nationalistic, but it's not even a fraction of nationalistic that China is. So China has to play to their home audience. They can't be seen to be buckling to the US. So they're going to play hardball for 3 to 6 months. When a China agreement is arrived at, I think it will be probably better than some had hoped for. And I think that could be very helpful for markets, both China markets and US markets.
Excellent. And if we are looking at US Treasuries, is there any concern that you have there? I know a lot of U.S. Treasury traders are obviously looking at this market.
Yeah, I mean, there was a good auction. I think it was yesterday. So I think because of the unsettled nature of equity markets right now, I think you're seeing more of an appetite for treasuries compared to, say, 2 months ago. So I think this volatility in equities really helps treasuries. It really just depends on the day, actually. But I think we're likely to see good news in the treasury market because of where Basant is trying to go on yields. He's trying to push those yields down. They're trying to cut spending. They're trying to do other things to bring yields down and fund with longer term debt.
And for those that don't understand how the Treasury can affect longer term yields, can you kind of explain that? What kind of their options are?
Yeah, I think, well, okay, let's go back to the last, say, year to 18 months of the Biden administration. Yellen had to fund the government. And so she adjusted the duration of the treasuries that they put out on the market from longer term to short term so that they could get money at a lower cost. Because what did she care? She would be out of office by the time those notes were due, right? And so Besant comes into office, or Besant. Is it Besant or Besant? I can't figure out.
I think it's Bessent.
Okay, Besant comes into
I think it's
office. I'm
Bessent.
sorry. Besant comes into office and he has all these short duration treasuries that he has to bring much longer for the US to be able to afford to operate longer, right? And so that's a conundrum that he has to deal with. So he has to change that duration while lowering yields, which is kind of an impossible situation. But we've seen yields fall over the past, say, 45 days or something. So, he's doing things to make those more attractive. And I think part of that is with the Fed and other organizations selling off some of their equities, it's making the equity markets less stable, raising the VIX and making it less attractive. So that's making bonds more attractive in terms of price, but not in terms of yield, actually. So we also have to keep in mind with bonds, I mean, just like equities with bonds, it's a relative game, right? And so what is Europe doing with their bonds? What is China doing with their bonds? And so are those attractive bonds to hold? Well, it's really questionable. And so, the US, whether people want to admit it or not, it's still a very attractive bond to hold. And when there is volatility in equity markets, it's a great place to put money for a period of time.
So the whole planet's not selling bonds as some people like us, selling U.S. Treasuries as some people like to say.
Yeah,
We still have forward
that's
buyers.
yeah, like, Asian countries selling their USTs. I mean, is China selling their USTs? Maybe they are, and buying gold. Yeah, maybe. There is some evidence to indicate that, but China holds their USTs in a number of different entities, some in the Caymans, some in Belgium, some elsewhere. So it's really hard to tell what's actually happening on a net basis with China. So, one can argue that that they are selling, but again, there's a web of entities that they use to hold USTs because they don't want the world to know how much they do hold.
They do that with commodities as well. So
Exactly.
that seems to be their MO, right?
Right.
They don't
Yeah, it
really
looks
like
like
the
equities
rest
are
of the
trading
world to
up on
know.
this. Yeah, it looks like equities are trading up on the on the release, Tracy, which is good, right? I mean, let's see what Powell can do to kind of screw that up, but it really looks like equities are liking what they're seeing in this.
Yeah, I mean, we're up a little bit. I mean, don't you think that, and Powell knows this, because there's kind of a risk of holding rates too high for too long. I mean,
Yep.
it's not that they're too high now, but, comparatively speaking to the zero bound that they've been
Right.
for the last, you know. So I think Powell probably knows that and
Sure.
would
Yeah, one of the other
going
things
to
I'd like
be,
to one of the things I'd like to cover, Tracy, I'm sorry, is the dollar. And so
yeah.
we have to look at where the dollar is. Again, the dollar was at 109 probably 6 weeks ago. It's now trading at 103 on the DX. Keep in mind that when Trump left office in 2021, the DX was at 90. So it was more than 10% lower than where it is right now. And for trade, for this administration to push the dollar lower, which I believe they will, it makes US equities less desirable as a place to hold wealth because the dollar isn't strong. It makes U.S. debt more desirable as a safe haven, and it makes the U.S. terms of trade better because it makes it harder for Americans to afford imports. So we really need to watch where the dollar is going to understand kind of what could happen in equity markets. And the dollar is down dramatically since Trump came into office. The euro is up pretty well since Trump came into office, and so the terms of trade for Europe are declining. The terms of trade for the are improving. Terms of trade for the U.S. are declining, and so we really have to pay attention to the dollar and the impacts on the dollar from these Fed and Treasury movements.
Do you think this administration wants a stronger dollar or a weaker dollar?
No, I think they want a weaker dollar. Trump showed in his first administration that he's comfortable with a weaker dollar. So every president says they want a strong dollar. So it doesn't matter what words he uses. Every president will say they want a strong dollar. But strength is relative. If we have, let's say, a DX at 115 or something, we blow up economies like China and other emerging markets and Europe and other things because their companies have debt in US dollars, right? So if their companies, if the dollar it trades at a lower valuation, then their companies can take on more US dollar debt, and that helps yields for US companies. So, it's a lower value dollar, depending on the political aims that the administration has. I would say at this point, there's a bias toward at least a 5% decline in dollar value over the next, say, 3 to 6 months.
Interesting. Well, currency traders out there that are trading currencies would be interested in that, absolutely. And any final words before we head into before we say goodbye and we head into this presser and we have another trader up?
Yeah, Tracy, you know my bias against Powell. He's going to say something. I don't know what that nugget is, but he's going to say something that he regrets. And people are going to have to come in over the next week to fix it. So just pay attention to what that nugget is, because that tells you what he's really thinking.
Absolutely. Absolutely. And looks like we have just another minute here. So what are you keeping an eye on in the markets specifically, over the next couple of weeks or so?
Tracy, I'm always keeping my eye on oil price. And I know this administration is keeping their eye on oil price and gas prices because their view is that that's the origin of inflation. And these Russia-Ukraine peace talks are related to oil price, I believe. OPEC plus discussions are related to oil price. Policy with Venezuela is related to oil price. Policy with Mexico is related to oil price. So, I'm keeping my eye on the dollar, on oil price, and on S&P levels primarily. Those are the three things that I'm watching. Of course, there's always gold, but I think that gold is on its own journey right now. But those three are really the things that I'm focusing on at the moment.
On its own journey. It looks like, I keep wanting to say, is it gone too far too fast? But there's literally, I can't find a reason to actually short the market, that market. So,
yeah, I mean, if you look on a currency basis, I don't see a reason for gold to have a major pullback. It may level off, but unless something changes dramatically, we have interest rates rise, we have the dollar rally, and a few other things. I don't see a major reason for gold to fall. That could change at any times as conditions change, but I don't really see a major reason for an adjustment in gold price. Downward adjustment.
Absolutely. Exactly. I'm just waiting for silver to break out and catch up. I love the silver market.
That's right. Exactly. A little more industrial. It takes a while, as you say, to catch up, for sure.
All right. All right, Tony. Well, thank you so much for your time today. Hope to have you back again.
Anytime.
And thank you, Vin.
Thank you. Thanks.